Howdy, Jacob here. Today we're looking at Fox Factory Holdings in the automobile components industry. Looks like they design, engineer, manufacture, and market performance-defining products and systems worldwide. Their growth in revenue has been very impressive. Pretty big hit the last year, but prior to that was growing almost 20% a year on the revenue side. We saw an increase in gross and operating margin. However, operating margin did decline from a small hit in revenue this year. So it looks like there was some fixed costs that couldn't necessarily go away that dampened that bottom line a little bit, but still looking pretty impressive. Return on invested capital, again, outside of this last year, consistently in those low teens, maybe. So very solid. Income statement shows a little bit of money being spent on R&D. You're looking at almost 4% of um, maybe around a little under 5% of revenue being expensed as research and development, taking money away from today to hopefully make more in the future. Not everything's going to hit, but the ones that do can be fantastic returns to the top. And most importantly, the bottom line. Again, we see that there were some fixed costs like sales, general admin, they couldn't necessarily get rid of, and cost of goods sold. But even still, they've been growing quite a bit. Balance sheet shows only 84 million cash on hand with no short-term debt, but 744 million long-term debt. So it looks like there was some acquisition here, increase of over 300 million for goodwill. And so they went into debt to fund some of that acquisition. Yep. And we do see that majority of free cash flow is going towards acquisitions. So we're not necessarily seeing as much organic growth, but if you're improving your bottom line, then I don't mind growing through acquisition because that means you're strategically going through acquisition, caring about the bottom line, caring about the investor and getting a maximum return on earnings and free cash flow. And so based on that, for now, looks okay. I don't like that their free cash flow went down after this massive acquisition. That seems a bit iffy to me. Why are you spending so much money and you're not hitting the bottom line? Obviously, it's going to take time for synergy to occur where two companies combine their resources together. It's going to take a little bit of time to really benefit from acquiring the other business. But we should see in a year or two whether that's the case or not. And if you have a declining free cash flow after an acquisition, even after a couple years, that means it was a terrible acquisition in my eyes. I mean, again, there's a lot of things that it could have improved upon that are more long term. But I mean, most companies think so short term that my long term of 3 to 5 years seems like forever to some management. But even still, I think I'm ready to make some assumptions here. On the revenue growth side, I think their revenue is going to dampen a little bit, but still looking at some impressive revenue growth figures here. Maybe let's go 8% or so. Just based on them having a bit of debt in relation to their um, market cap. I think I'm just going to go right around market average here. And again, that paying off a little bit of debt is going to dampen their growth a little bit because they generously, let's say 100 million in free cash flow and have 744 million long-term debt. So over 7 times their 1 year average or multi-year average free cash flow. That's a bit concerning. So they're going to be spending a little bit of money on debt reduction, which is going to dampen their ability to deploy capital in other places. Either way, let's say no growth or no change of shares for margins. Free cash flow being a bit lower is a little bit concerning to me, but let's go 8 and 7%. And I mean, I guess it's saying it's a good price, but again, I might be a bit overly dramatic here. So let's say it dampens a little bit since they finally are getting hit with some negative year over year growth. Let's say that impacts their revenue a little bit. Still only 22% drop before we get the return I look for here. So this would be something that I'd want to do a deeper dive on, see if they can continue this growth or even close to it and make sure that they're deploying capital the way I would want to. Because again, I've said it before, but even if something looks like a buy, you don't own the business. And so if you deploy capital or if you imagine ways that you can deploy capital to get these types of return based on historical data. You can't guarantee that a company is going to do that. And so you need extra margin here. And this is the type of business I don't necessarily know, a whole lot of what they do and how they make their money. And so until I become entirely confident in that, I definitely would need a higher margin of safety. And even so, I've had businesses that look like screaming deals to me that I just can't understand, and I don't buy them because I don't understand them. And so keep that in mind, even when things look at a great price. If you can't understand it, um, you're just doing basic math here when you do a present value calculation, but you can't determine whether these numbers are actually true or not, or can hold or not. And that's something that you shouldn't be investing in my perspective. But obviously, everyone to each their own. Do what you want. But for me, even this is still something I'd still be interested to do a deeper dive on in a short period of time when it gets to a more attractive price. But I'm pretty darn close. Hope you enjoy this video. Have a great day.